What's up with this market? We tired? Have we run out of gas? What's the story?
I think the market's consolidating and maybe trying to get direction from what the market does, because we did gain 28% from the April lows. We got to digest that. Now we're in August, like the dog days of August, where liquidity is lower. And I think that we're still holding our breath because we're in a period where the Fed isn't going to make an interest rate decision until September. So some of the key macro is kind of on hold. So I think markets are wait and see, but I'd say that pullbacks have been shallow.
Is it fair to say there's a more sober view from investors about stocks? I mean, you've been suggesting that this is a hated V-shaped recovery, even as we continue to climb this wall of worry until most recently, where we've sort of sputtered in place.
That's right. I mean, it's definitely the most hated. I can attest to it from our conversations with clients. We can see it measured in surveys like AAII, where there's stubborn bearishness net still. And then we did the rounds, Fundstrat did the rounds with a lot of our institutional clients the last 2 weeks. And I think folks are very cautious, which is actually good for stocks. They're cautious because, of course, markets have moved, and our clients tend to be valuation sensitive. But I think adding to their frustration is that during that April downturn, many were selling their best names because they were trying to get defensive, and then they haven't fully reloaded yet. So I think that's why there's still room for stocks to go up.
So your clients are valuation sensitive, which makes me almost want to laugh, because is anybody valuation sensitive to what's been going on in the market? We're historically well above the averages on the prices that you're willing to pay for stocks.
Yes. I mean, what we usually tell our clients, but really at the core, any fundamental investor is going to use valuation as really one of their anchors, is that the stock market had 6 stress tests in the last 5 years, from COVID to the bullwhip supply chain, to the fastest inflation cycle in history, to the fastest Fed hikes in history, then to the Trump tariffs, and then, of course, U.S. bombing nuclear facilities of Iran. Those are things that could cause catastrophes for earnings, but instead the S&P earnings have actually grown. So I think we're in the process of re-rating the S&P. So I actually think multiples will continue drifting higher.
Okay, so let's talk about other so-called knocks on the market. Valuation, obviously, one of them. They say there's too much speculation. You look at some of these stocks, meme stocks, low-quality stocks, cult stocks, and other things that have gone up. What's happening with these stocks? What's happening with some of this fervor that feels like it's in the market?
Well, I think the dearth of IPOs over the last 5 or 6 years has shrunk the number of stocks in the U.S. stock market. There's not even 5,000 listed stocks anymore. Yeah,
I can give you 50 examples of other things that have just gone absolutely parabolic.
Yeah. Well, I think like a Circle is a good example of scarcity, because that was the best IPO really in 5 or 6 years. But it's a blue chip company. They are the biggest compliant issuer of stablecoins in the U.S. and it's growing prodigiously. So in a way, it makes sense that it went from, a $20 IPO to 200 today, because it's scarce. It's just as scarce as a Palantir, but with a different market size. And I think that these quality names like a Figma represents that same scarcity, because we actually have a shrinking number of stocks out there. There's a lot more privately held companies, but the public market's small. And then if you think about it, there's every year dividends are paid on the S&P. That's sitting on the sidelines. There's $7 trillion of cash on the sidelines. People make income and they're saving 10%. If they don't buy stocks and they haven't been able to buy homes, this cash is piling up, and that's why it probably goes into the stock market.
Okay, so the knock of valuation, the knock speculation. What about the knock of concentration? NVIDIA has the biggest weight in the S&P 500 of any individual stock since 1981, since data was being collected. The largest 10% of U.S. stocks now account for 76% of total U.S. market cap. That's the highest concentration in history. The top 10 names in the S&P account for 40% of the index. Does that give you any pause?
I think when people cite these numbers, and I've also heard Max Myers say that, like, 2 stocks are bigger than like Tokyo's entire stock market.
Max is going to love the shout out, by the way.
Yeah.
Anyway, please go ahead.
That we have to think about the earnings contribution. NVIDIA is producing incremental earnings at an incremental margin that tells you it's an incredibly scarce company. They're not making enough chips, and they are the center of the AI revolution. So I'm not surprised it's the biggest stock. I think from an earnings growth contribution, it's so big that those previous measurements aren't accurate.
Okay. Last one. The consumer, not as great as everybody says. Brian Moynihan, Bank of America, comes on the network this week, has great things to say. I always say, don't listen to what people say. They're going to do, listen to what they actually do. And what they're doing is still spending money. Hugh Johnson, Disney, says, I know there's a lot of concern about the consumer. Well, we don't see it. Our consumer's doing very well. Under Armour, Crocs, Ralph Lauren, Pinterest, restaurant brands, Sweet Green, Wendy's, Chipotle, Jack in the Box, Yum brands. I could go on and on even further than that, which might tell a little bit of a different story. So how do I square that?
Well, I think there's consumer preferences could be shifting. Because you remember, post-COVID, there was this boom in eating out and dining experiences. And we shouldn't say that that's a permanent change, and that's why you're seeing some of these. I don't think consumers are over-levered. To me, that's the sign of a peak in consumers because they can't amplify their spending. That's what the banks are going to tell you. And if you look at the Fed's debt service ratio, we're still below COVID levels. So
people keep saying delinquencies are going up, consumers stretched.
I think that, of course, at any moment there is, but really in aggregate, you can't get a levered consumer until you have a housing boom. So consumers might be on short-term credit, some of these being stressed, but that's very different than us actually peaking really from long-term credit borrowing in a binge.
So that's why you say we're going to hit 6,600 by year end on the S&P, or it's almost 64 now. That's not like a tremendous move from here.
Yeah, I mean, I think our year-end target is probably low because I think we could do 6,600 this month. I think this is the month.
This month?
Yeah, I think we're going to have a breakaway move in the S&P this month.
Even in what is a historically, not the best seasonal period for stocks, as we know. August is usually like a nothing burger, and then September is usually a reversal.
That's
negative.
Right. I think that's everyone's playbook, that August should be weak and September down. But precisely for that reason, with the economy being stronger than people realize, Bitcoin made a breakaway move on July 9th. It has led the S&P for the last 5 years by almost 1 month. So I think a breakaway upside move in the S&P is coming.
All right.
Yeah.
That's your call?
I would say that's our base case, yes.
Starts next week.
I mean, I can't give you the hour and the day.
You said it might start next week.
But that's 5 days.
You want to put yourself out there by all means.
Yeah, but I think it starts within the next week, yes.
Okay. Stay with us. We'll expand the conversation. Let's bring in CNBC contributor Courtney Garcia of Payne Capital Management and Obermeyer Wealth Partners, Allie Flynn Phillips. It's great to have you both with us. Court, you sat here. You heard everything that we talked about. He went right down the checklist. Valuation, that's not a problem. Too much speculation, not really. Too much concentration, it's justified. Is a consumer bad? No. Consumers find seasonals. He's a contrarian. He said we could have this rally starting next week. What do you say?
Yeah, I do think that we are well positioned here for a good second half of the year. I mean, we just continue to get good data on the economy. There is some questions with the labor market, and so I think we want to continue to see how that comes out. But I think at this point, we're just not seeing the consumer fall off a cliff, to your point. Like, yes, credit card balances are going up, but we're nowhere near like the peak levels we were before COVID. So I really don't see this issue where we're going to go into some sort of a recession. And I also think if the Fed starts to lower interest rates, which is widely expected they will in September, those money market funds are going to be paying less and less. So that's one rate cut. But especially if we see multiple rate cuts, you're going to start to see some of that money coming back out and making its way back into the markets, which has not been happening over the last year. But at some point, you're going to start to see that as well. And that's something that I don't think is priced in at this point in time.
Allie, what's your take here?
I don't know. I think the best way to describe this environment is like a tug of war between the economic drag of tariffs and then the U.S. corporate earnings strength. The latter's winning so far, but getting granular is key to see in terms of which companies and consumers are going to eat these tariff costs. If you look at the earnings season so far, is largely fueled by artificial intelligence and financials. Around 80% of the companies exceeded expectations, which led to, in terms of revenue margin growth, surprisingly resilient and increase in terms of estimates for 25-26. But there's this huge bifurcation. As we talked about earlier, the Magnificent Seven stocks, average earnings about 26% versus the rest of the market 5%. We should see that convergence, but this sort of imbalance of power to us is in terms of disturbing long term. As much as I love the bullish sentiment today, we wouldn't be surprised if you see a little bit of this tension between in terms of the earnings and this sort of tariff framework. I mean, tariffs likely are set up about 19%, which we do think is an economic drag. But for us, we wouldn't be surprised if we see a pullback. But in that case, we think you have to be poised to take advantage of some good opportunities.
By the dip, Tom, is like even those who suggest you could be in for a period of bumpiness, maybe some turbulence, maybe some kind of a pullback. The suggestions have been that they would be bought pretty quickly.
Yeah, I mean, really since 2020, the dips have been shallow unless we have structural problems. I would say it's a good sign that investors are cautious, which is what we're finding. And as Laura was mentioning, there's tariff concerns. People just want to get through and see what tariff impacts there are. But we also know that consumer expectations around inflation are cooling. I mean, it's prevalent in the UMich surveys, the Consumer Conference Board, and also the New York Fed. So I think the Fed correctly is being patient, but that's a catalyst, because if we think there's cuts in the fall, that's good for stocks.
I did also see today, it was Bank of America's Flow Show, which showed a fair amount of money moving to cash. Maybe there's some anticipation of a pullback. Maybe not a full-blown correction, but a pullback that wouldn't feel that great.
Yeah, and I think pullbacks are normal, obviously, especially after this kind of run-up that we've had since April. So I do hope that this turnaround happens next week, which you're calling for. I would love that. But I do think if there is a pullback, it absolutely is going to be a buying opportunity. But the question is where you're buying into. Because, yeah, there's this huge concentration we talk about right now. Those 10 stocks, about 40% of the markets right now. And that's where something, I don't know if that trade is over. I'm not saying get out of those stocks. But a lot of clients have looked at their portfolios, and they have no idea how concentrated they are. They have all these different mutual funds, a bunch of stocks they own. If you look at them in aggregate, you own so much exposure to these 10 companies. And that's what I want to caution investors. Say, own those, but make sure you're not owning so much of it that if those things start to pull back, or you do start to see international continue to outperform, if there's this rotation to small caps, whatever it is, you want to make sure that you're diversifying your money, especially on any pullbacks that we see.
Ali, where do you come down on that? There's a reason why they're concentrated. The earnings season pretty much just told you why the money continues to go there. Do I just want to stay there and play whatever offense I think I can get still? And look, the defense that these stocks have provided investors is a draw as well.
Well, the nice thing about it is there's other opportunities out there. And we've had a lot of talk about NVIDIA, which we like as a great company, but why don't we pair it with something like Taiwan Semiconductor? You know, complex high performance computing chips is a growing industry where TSM has about a 9% market share and growing. It just beat expectations across the board, but it's trading at 22 times earnings, not 30 times earnings. Eventually, it actually should really trade at a premium to the S&P, given its moat. But right now, to us, something like that looks like a deal. Moving into a different sector, animal health, Zoetis, a resilient and growing industry. Animal health is probably GDP plus. As we know, many people will forgo their own health expenses for pet expenses. Long term, we see this humanization of pets. And because everyone's been so focused on Mag 7, you've seen in terms of real earnings compression in a company like this, to us, that's a great entry point. And then also remember is we can look up, we can look overseas. Something like in terms of some of the data centers to us would be attractive as well.
Tom, what about a big, beautiful broadening this market? Does that come?
I think we're primed for that because the equal weighted S&P PE is 16.9 right now. It was almost 18 on the eve of COVID. So the market has gotten cheaper after facing all these stress, even at an all-time high. So is the case for stocks having better earnings performance there? Yes, if the Fed starts cutting and we're onshoring and the ISM's been below 50 for almost 30 months now. We haven't really seen a peak of a cycle until ISM breaks above 50 for a sustained period. That's earnings broadening. Yeah, and that's great. That would be great for industrials, financials, and, as I quietly say, small caps.
I knew you were going to go there, which I've had a pretty good week on rate cut expectations. Yes. But the reason why the equal weight has gotten cheaper, it's the cheapest since COVID, is because AI happened since COVID. So it's inflated the PEs of the top-heavy stocks and made all the others appear even cheaper because so much money has been going to the large-cap tech names.
True.
So it's skewed a little bit simply because of the AI trade.
That's true. But then we should think of it in sort of second-order effects. The first is that the earnings growth of the median stock has actually been very good. So, and we saw it in earnings season because 83% are beating, and now the stacked earnings 2Q versus 2Q is over 12%. That's not just the Mag 7. But the second is that we know that the AI is progressing at a pace that it's delivering real benefits to companies. So companies are now going to see the benefits. I can't point to what it'll be, but it's probably margins. And so that's a story that should be broadening earnings performance.
Well, depending on the impact of tariffs.
Correct. And tariffs are things that are well telegraphed and socialized. And as soon as markets view it as one time, we will actually look through those.
Yeah, but not maybe from a price increase standpoint, but not necessarily a margin hit, as you're already hearing from some of the retailers. They're just trying to get their arms around exactly what all this is going to mean for their margins and their prices.
That's right. So, Scott, let's keep in mind tariffs are going to create winners and losers because the companies that imports are 10% of our economy, and the companies that are highly reliant on imports are going to have effects that they have to reprice their business and margins. But that, if someone said that should take down S&P earnings and the S&P 500, they're overlooking that the S&P is a broad set of companies.
Earnings going to hold up?
I mean, so far they have been, and I do think we're probably well positioned here. And let's not forget, we're looking at this concentration that's been happening in the markets. But when you look out about 12 months out, 12 months from now, in the past, I'm trying to say. But you're seeing things like financials, industrials, consumer discretionary. Those are all up over 25%. So yes, tech is doing well, but you have actually been seeing money go into other areas. And I do think at some point here, you are going to continue to see that. Again, especially interest rates coming down are going to be a big key of this, which is likely happening in the fall.
I mean, the earnings picture that Tom paints is right. Our markets desk passed a note out today referring to the results as stunning. Earnings performance up 13.2% versus the year-ago quarter, almost 9% above earnings expectations. So there is data to support this picture. The question is, does it maintain itself?
And you're seeing that in guidance where companies have had really strong earnings, but they are being a little cautious moving forward, saying we don't really know how tariffs are going to impact us. We don't know how tariffs are going to impact the consumer. And I think that's where you are starting to see people aren't sure exactly how it's going to come out in the next couple of months, in the next couple of quarters here. But I am hopeful that we are going to continue to see these earnings coming in stronger than expectations. I think the bar is likely lowered because of the tariffs. And especially if you start to see all this come in towards the end of the year, I think it's just really setting up for a strong second half and a strong next couple quarters.
All right, we're going to leave it there. Courtney, thank you. Ali, thank you. And of course, Tom Lee, thank you. All right.